Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, I'd like to talk about the difference between debt consolidation and debt restructuring. So before we can compare and contrast, let's make sure we understand the definition of a consolidation versus a restructuring. Debt consolidation is the process of turning a bunch of separate debts into one single debt. So you might go to, say, your bank and ask for a debt consolidation loan, and they might require for you to have the proceeds of the loan paid directly to some of your current debts that you might have, like credit cards or other loans. They might require you to close off that credit card or those other loans that you're paying off as a condition of getting approved for that loan. But either way, it eliminates having to make a bunch of different payments to different creditors. It might even reduce your interest rate or reduce your payment. So there are a couple of examples of what might fall inside of a debt consolidation. So there are debt consolidation loans. You could also do a balance transfer from one credit card to another. And then another example is a debt settlement. So let's break each one of these down. Debt consolidation loans are the most common of these examples I've used. And again, there might be some requirements to pay off or even close an account if you're going to use the debt consolidation loan to pay that off. Basically to keep you from getting into additional trouble. You don't want to take on this additional loan and still have that, say, big credit card that the intention of that money was to go and pay it off, but then you use that money for something else. A balance transfer from one credit card to another can be an amazing strategy if you are paying a very high interest rate with a larger balance on a current credit card. So the strategy here is to find a low or 0% introductory rate from a new credit card where you can transfer that balance over. A couple of words of warning about this. Just know that most of those credit cards will charge a balance transfer fee. It's usually 3% of the balance or the amount that you're going to be moving over. So take that current balance, multiply it by 3%, and just know that that is going to be the fee added to your new balance on the new credit card. However, if you are no longer paying, say, 20-something% for an extended amount of time, this could be an amazing strategy to have 100% of your monthly payment going towards reducing that balance. There are many credit cards out there that will offer 12 to even 18 months, 0%. Now, here comes the warning. Make sure that you pay off that balance in full by the time that introductory period is over. And second warning is, if you are truly going to use this to eliminate paying interest, to make that credit card balance go away, to get it gone, it's really important not to use that first credit card anymore and just keep it at a zero balance. I've seen a lot of people have a really good intention on moving over that balance, but then what they've done is they've gone back to that original credit card and started using it again. So now you have two credit cards with balances that you're servicing that debt. And that's just getting you further into debt. So along with the action of eliminating that interest by moving that balance over to that introductory 0%, it's really important not to keep using that credit card and getting further into debt. So just be very careful with that. So now let's talk about debt settlement. As part of debt consolidation. A debt settlement is really when you utilize a company to be like that negotiator with your creditors on your behalf. An example would be a company like National Debt Relief. So you make an agreement with them for a monthly payment, and then they store it up and save until you have enough. In the meantime, they are negotiating with your creditors on your behalf to find out how much they will accept as a settlement So when you have enough saved up inside of this debt settlement company, they'll pay your creditor a lump sum and your creditor will forgive the rest. This is an excellent way to reduce how much is owed to your creditors, but it will absolutely destroy your credit. So here's what's going to happen. If it's a credit card, your credit card gets closed up, so you no longer have available credit to go to. However, you'll have an outstanding balance against a zero limit because once your credit card is closed, it now has zero availability. And while the debt settlement company is working with your creditor, there's a really good likelihood they're not making those payments to your creditor. So that trade line is likely very late now. So all of those late payments plus the closed up account, and then it's going to wind up going into a collection status or even a charge off. And if you've listened to a prior episode of mine, you know that if a credit card goes into charge-off status, it's actually a double whammy. It hurts your credit for being in the collection status, but it also hurts your credit because it's reporting it as a revolving, where if it's just a collection, it would show it as open. But when it's reported as a revolving under that charge-off status, it's got that zero limit and that outstanding balance. So it can slaughter your debt utilization. Adding to that, those late payments, the new collection, those kinds of things, it will absolutely destroy your credit in the short run. So let's compare these debt consolidation examples to debt restructuring. There are a couple of ways that you can go about debt restructuring. The first way is directly with your creditors. This is when you approach them and say, listen, my financial situation is a mess. I am on the verge of bankruptcy. I'd really like to not have to go that way. Will you work with me to restructure my current debt in a way that will allow me to repay you without having to go into bankruptcy? So an example of debt restructuring that you could do on your own, I saw it done a lot in 2008 to 2011 with mortgage loan modifications. So sometimes those lenders would extend out the payment to, say, 40 years instead of 30 years. Sometimes they reduced the interest rate for a certain period of time, so more of your money was going towards the principal reduction, but it also reduced that monthly payment to free up a little cash out of your monthly budget. So the only way a creditor is going to agree to debt restructuring is if they truly believe the other option is bankruptcy, because if it's bankruptcy, that debt gets washed away. If you file a Chapter 7, they get paid less if you go with a Chapter 13. So Chapter 7 is where all of your debts that are included in the bankruptcy get wiped to zero. And essentially, the creditors have to write it off. A Chapter 13 is a restructuring of payments to those creditors, and they typically end up getting paid far less on the balance owed than what they would be if you weren't in a Chapter 13. So in that case, a creditor would likely be open to having a conversation about some possibilities of debt restructuring, maybe reducing that interest rate, giving you some additional time to pay, extending out the life of your loan, those kinds of things. So you would be looking at a debt consolidation if you have many debts, where a restructuring of debt is really just focusing on one trade line or one debt. When it comes to debt restructuring, your lender or creditor, they have to agree to that process. And again, you likely have to show or prove a significant financial struggle. So now let's talk about the credit impact if we're looking at consolidation or restructuring. Let's talk about debt consolidation. So let's say you go to a bank or a lender and you say, hey, I'd like to get a debt consolidation loan or a personal loan or unsecured loan so that I can pay off this debt over here. A lot of times that installment loan is going to have a lower interest rate than what credit cards might have. The average credit card APR right now is 20%. And if you have store credit cards, it's likely closer to 30% and going up because the prime index rate keeps increasing. And so that is what your APRs are tied to. So in that case, if they grant you that loan and you pay those other debts off, that's the cleanest, least impact on your credit report. If you keep those credit cards open with zero balance, that's great. If you close them and you had those credit cards long term, it could have a negative impact on your credit score because you've closed up a long-standing trade line. And if you do get this new loan, please make sure you are utilizing that to pay off existing high interest rate debts or high payment. If you're talking about restructuring, a lot of times this could really preserve your credit. So if you went straight to your lender or creditor and asked for some kind of a modification, either just a reduced interest rate, or if it's a loan, a longer time to make those payments, maybe extending out the life of that loan, a lot of times it will get reported to your credit report as a modified loan, but it has very little impact on your credit. Just keep those payments up. I know back in the day when I was was doing short sale negotiations and loan modifications for mortgage loans, the mortgage loan servicers were requiring your mortgage payment to be late by 90 days before they would even consider your request. And so that really slaughtered your credit profile and your credit score. So as long as your creditor doesn't require that first before considering modifying that loan or those agreed upon terms, and they just report it as modified loan, minimal impact, if any, to your credit profile and credit score. But if you do go into debt restructuring through a Chapter 13 bankruptcy, all of those trade lines that are included inside of that bankruptcy on that repayment will be listed as such, and that Chapter 13 will be listed on your credit report for 7 years. And that can drag down your credit score. So I'm not endorsing one way over the other, nor am I suggesting to go to a particular company for debt settlement. I did just want to describe them and explain it a little bit, so if you are considering something like this, you at least have some definitions in front of you, and be very thoughtful through your consideration of what to do next if you do find yourself buried in debt, because what you decide today will have a very big impact on your tomorrow. If you have questions, please reach out to me at questions@creditchristie.com. I hope this information finds you well, and until next time, my friends, stay well.